Many traders make mistakes and many traders lose money. In fact, there have been academic research papers published suggesting that 90% of traders that participate in the markets are actually unprofitable. But here's the thing, I'm not even here to debunk that. I'm not even here to tell you that that's incorrect. In fact, I genuinely believe that that is a real statistic. But I do want to put something into context. See, the reality is, in regards to trading, the barrier to entry is literally non-existent, meaning that anyone could open up a brokerage account, anyone could fund that brokerage account, and anyone could begin trading immediately and lose their capital. It doesn't matter what your IQ level is. In fact, when I was working at the bank, I had a brain surgeon sit down across on my desk, and we were having some conversations, of course, as I typically used to have as a banker. And one of the conversations led to this brain surgeon talking about how he's tried trading and he lost $70,000 in one single day.
That is wild, isn't it? It's just wild.
And here's the thing, a brain surgeon is someone who's perceived as generally smart. But again, the reality is the barrier to entry is relatively low, and that causes a lot of issues. For example, becoming a brain surgeon is something that you just can't roll out of bed and actually become a brain surgeon, right? You have to go through schooling. I mean, there's a lot to it. In fact, I do have a cousin becoming a doctor, and of course, it's years of going into school, years of actually gaining knowledge. And even after that, it's not like you just jump into the field. You also have to do residency. So there's a lot to it before you actually just put your lab coat on and actually operate on someone. However, for trading, it's not treated the same way. And so I believe that if it was actually measured differently, where we had individuals who didn't start trading with their real capital right away, in fact, they took years to learn the market and understand monetary policy, fiscal policy, understand the fundamentals, understand technicals, understand alternative data, and try to take as many courses or read as many books as they can on the overall markets, I guarantee you that if you were to measure the success rate of those individuals who learned risk management and took the time to actually learn to trade, well, then the results would be completely different from anyone who just opens a brokerage account and starts trading to lose capital. Now, I see this time and time again where traders are trading like they're trying to retire tomorrow and buy a yacht over in Miami. And the reality is that you cannot approach trading with this mentality. You have to look at trading as a series of trades. You can't just try to get rich overnight with an overnight get rich quick scheme, right? This is nothing like that. In fact, the reality is that it's going to take some time to actually build wealth trading, and you're going to have to scale that up over time. And the reality is, when you're trading, whether it's stocks or options or whatever financial instrument that you're trading, you don't want to go all in with your capital. Now, before we actually go a bit deeper into this, I do want us to acknowledge that trading and investing are two completely separate vehicles. And the reason why I want us to acknowledge this is because many market participants are not even aware of what they're doing, or if they're investing for the long term, or if they're just trying to trade. Many individuals don't even know, which is why you have to ask yourself. And in my opinion, I believe that most individuals will do far better off not even trading and just investing in passive index funds. However, for the individuals who are already investing in passive index funds and do have extra capital that they want to risk for trading, then this is the video for you, of course, right? Investing is something completely different. Now, when we're talking about trading, one of the things that we have to understand is, like I said, you can't go all in. So if you have an account of, let's say, 100,000 or 20,000, 25,000, when you're entering into a trade, you have to have a predetermined amount that you go ahead and enter into that trade. Now, of course, your risk management is going to be slightly different depending on your entire approach and also what instruments you trade. For example, when it comes to stocks, I don't mind, let's say if I had a $100,000 account, breaking it into like 4 different positions where I scale in with 25,000, and if it's going upwards, I'll add in another 25 and add in another, and then eventually sell off, as long as I have a risk management of selling at a loss at 1% if it does end up falling down. But when it comes to options, I never recommend ever even putting more than 15% over your overall account, even if it is for a day trade. Now, I want us to remember that. See, for stocks, it's okay to put, and again, this is just using the $100,000 account. If you have $100,000, you could put 25 in for a day trade. As it goes up, put another 25 and put another 25 and then sell in for a profit or for a loss. But for different instruments, especially derivatives like options, where you're not only fighting against direction, but also fighting against time, that is a completely different approach, which requires a completely different sets of risk management. But at the end of the day, the same concept applies for whatever instrument you trade. You should not go all in immediately. Again, you can't put just $100,000 in one entry for stocks if that's your entire portfolio. It would make no sense. In fact, I have several videos talking about this in my video lesson library for the Push of Profit private group, but for the sake of this video, I'm going to go ahead and talk about it more over here. See, the go big or go home mentality is something that is unfortunately ridiculously common in regards to participating in the markets, and the problem is it could lead to several different factors. See, there's an emotional or psychological aspect where when you're trading with a large set of capital and essentially using your entire account for one trade, well, now you have this emotional attachment where even if you have rules set up for risk management where you're like, hey, I should cut losses at 1% or whatever percentage you have determined, you may neglect your actual risk management simply because now you're feeling, well, I can't lose because I have so much invested, and in fact, if it goes down, this is going to hurt me, so I'm just going to hold and really cross my fingers, and that's called hopium, right? Because then what ends up happening is now it actually could fall down further, whatever instrument you're trading, and now you have even more of an emotional attachment where now you just feel like, well, no, I'm in it to the end, and that's how you essentially can blow up your entire account. And so the number one quality to become a successful trader is honestly just discipline. If you're someone who wakes up in the morning and you don't even have the discipline to make your bed in the morning, then probably you shouldn't be trading. If you're someone who you know that cold showers are beneficial for your skin and overall just beneficial for your health, but you just can't do it because cold showers are too cold, then perhaps you shouldn't be trading. Now again, I'm not here to tell you, oh, you have to do this routine and this routine. All I'm trying to say is that basically, if you're not an individual who could discipline yourself for the sake of your own benefit, then you probably should not be trading. And so when I talk about having small wins and using that to slowly scale up and grow your account and eventually build wealth that way, it seems very unattractive for many individuals wanting to participate in the markets because, again, the idea that many individuals have is that they want to get rich overnight. Again, that's the main thing. And so if you were to just tell someone that, hey, that's not the reality, I'm sure half the people that try to enter into the door won't even want to enter in. They'll probably, again, just probably do something silly like playing the lotto. And so if your desire is to become a successful trader, then the reality is you have to adopt the mentality that you can't be going all in for these trades. I mean, you see it over all the time where people make those one-hit trades and they become millionaires, and it does happen. I'm not saying that that can't happen, but a lot of people tend to see stories like that and not understand that that's just an exception, right? And many times those stories end up very unfortunate where they end up making a lot and they end up losing a lot as well, right? And so you have to understand the idea that it's going to take a series of small trades and you have to scale up slowly, because the idea is having longevity, right? The longer that you could stay in the game, the longer that, or the more potential that you have in actually being successful. See, the idea is just having enough capital to not get wiped out, because as long as you're using your risk management properly, then you'll be fine as long as you're just slowly scaling your account and making those small wins. Now, hopefully what you got from this video is that you should never go all in one trade with all your capital, as this isn't something that's likely to exponentially put you forward as many may believe, and it's actually more likely to set you exponentially back. And so, of course, there are many other mistakes that you can make in regards to trading, but as long as you could avoid this one big mistake, you'll have the longevity to actually start correcting all the other mistakes, which are much more manageable. But with that said, guys, hopefully you guys enjoyed this video. But before you guys go, I encourage you guys to watch this video right over here, especially because I break down some other concepts in regards to trading.